Hello everyone, welcome to the market opening bell on Monday, April 14. Trade war updates. On April 11, the Trump administration announced exemptions from reciprocal tariffs for smartphones, computers, and most electronic products imported from China, providing relief for major tech companies like Apple and Nvidia. However, several media outlets report that the White House is set to launch a new national security trade investigation into semiconductors, which could lead to new tariffs on the chip industry. Trump indicated more details will be provided early this week. Additionally, there are reports that Trump is considering delisting Chinese companies from U.S. exchanges. The incoming SEC chairman, Paul Atkins, may address this issue after taking office. Currently, over 100 Chinese companies listed in the US have a combined market value exceeding 776 billion US dollars, approximately 6 trillion Hong Kong dollars. If these companies seek to list in Hong Kong, it could expand the Hong Kong market's size and offer investors more options, though it may also strain liquidity, a double-edged sword. Hong Kong market recap. On Friday, Hong Kong stocks opened lower but closed higher. The Hang Seng Index opened down 125 points, hitting a low of 20,444, down 238 points. It then rebounded sharply, peaking at 21,127 in early afternoon trading, up 445 points, and closed at 20,915, up 233 points or 1.1%, with a turnover of 276.2 billion Hong Kong dollars. For the week, the HSI fell 1,935 points or 8.5%, marking its fifth consecutive weekly decline. The X-share index closed at 7,802, up 134 points or 1.7%, but down 7.3% for the week. The Hang Seng Tech Index closed at 4,900, up 86 points or 1.8%, but down 7.8% weekly. Both the H-share and tech indexes also fell for 5 straight weeks. Mainland Chinese markets follow a similar pattern on Friday. The Shanghai Composite Index hit the low of 3,211, closing at 3,238, up 15 points or 0.5%, but down 3.1% for the week. The Shenzhen Component Index hit a low of 9,679, closing at 9,834, up 80 points or 0.8%, but down 5.1% weekly. The renminbi central parity rate against the US dollar was set at 7.2087, up 5 pips from the previous day, marking the first increase in 7 trading days. Economic data. On Sunday evening, the People's Bank of China announced that renminbi loans increased by 9.78 trillion yuan in Q1 2025. The total social financing scale rose by 15.18 trillion yuan, up 2.37 trillion yuan from the same period last year. In March, new social financing reached 5.89 trillion yuan, and new renminbi loans hit 3.64 trillion yuan, surpassing market expectations of 3 trillion yuan. Analysts noted that the recent rebound in credit demand is largely tied to proactive macro policies and stabilizing expectations. Technical analysis. The HSI held the 20,450 support level with Friday's high of 21,127, approaching the 100-day moving average at 21,190. The Hong Kong ADR closing on Friday projected an HSI opening of 21,196 today, up 281 points, a breakout of above the 100-day line with sustained momentum could partially fill last Monday's gap down, which spans 1,590 points between 22,638 and 21,048. Filling one-third of the gap would push the HSI to around 21,580. Filling half would target approximately 21,840. U.S. market recap. U.S. stocks surged late on Friday. The Dow Jones Industrial Average rose as much as 810 points, hitting 40,404 and closed up 619 points at 40,212. The S&P 500 gained 1.8%, closing at 5,363 with an intraday high of 2.2%. The Nasdaq climbed 2.1%, closing at 16,724, also up 2.2% intraday. For the week, the Dow rose about 5%. The S&P 500 rose 5.7%, its best weekly gain since November 2023, while the Nasdaq jumped 7.3%, its strongest performance since November 2022. Currency and commodities. The US dollar index fell below 100 to 99.869, down 1%, boosting other currencies. The yen appreciated 0.6% to 143.6 per US dollar. Gold prices hit a new record, reaching 3,245.48 US dollars, up 2.2%. U.S. economic data. The University of Michigan's Consumer Sentiment Index for April fell to 50.8, the lowest since June 2022, well below the expected 54.5. One-year inflation expectations surged from 5% to 6.7%, the highest since November 1981, while five-year expectations rose slightly from 4% to 4.4%, reflecting consumer concerns about tariff-driven inflation. Today, we compare two beauty stocks, Mao Geping, stock code 1318, and Shanghai Chicmax, stock code 2145. Let's start with their positioning. Mao Geping is positioned as a high-end cosmetic brand, focusing on makeup, example foundation, lipstick, and skincare, targeting affluent urban consumers. It primarily sells through offline retail channels like department store counters, but also via e-commerce platforms such as Tmall and Douyin. Shanghai Chicmax, on the other hand, operates as a multi-brand cosmetics company with brands like Cannes Skincare, One Leaf Musk, and Red Elephant maternal and baby care. It offers affordable products with a premium feel, targeting a broader audience from mass to mid to high-end consumers, and relies heavily on e-commerce, particularly Douyin. Financially, Mao Geping reported 2024 revenue of approximately 3.8 billion yuan, up 35% year-on-year, driven by offline expansion and Douyin live streaming sales. Its net profit was 880 million yuan, with a net profit margin of about 23% and a gross margin of 84.4%, reflecting its premium pricing advantage. Shanghai Chicmax recorded 2024 revenue of about 6.79 billion yuan, up 62.1% year-on-year, largely driven by Cannes. According to industry media, Cannes ranked second in online GMV among domestic beauty brands in 2024, with the fastest growth among top beauty brands. Its net profit was 781 million yuan, up 69.4% year-on-year, with a net profit margin of about 11.5% and a gross margin of 75.2%, lower than Mao Geping due to its mass market pricing. In terms of valuation, Mao Geping's historical PE ratio is around 43 times, higher than Shanghai Chicmax 23 times, likely reflecting its premium positioning. While Shanghai Chicmax profit margin lags behind Mao Geping, its multi-brand strategy diversifies risk, and its broader market coverage and steady growth should help narrow the valuation gap with Mao Geping. Recommended buy price is 47 Hong Kong dollars with a target of $51.5 and a stop loss at $44.5. I do not hold positions in the above stocks.